Welcome to the BF Anderson Technical Report for January the 11th. 7.5% rule, a rule that was very good to us last year. If you remember, and I want to remind you of what the rule is, the 7.5% rule is where the S&P 500 index closes the week, which was last Friday, 7.5% higher than the moving average, which is the 35-week moving average. The signal must be the first signal for 9 months. So this has only happened actually 5 times in the last, 10 times, now 11 times since 1980 because we got a signal last year. So basically the conclusion of this is that this blast-off indicator, which is what we're dealing with here, this is a blast-off situation, since 1980, the average gain in the year of the signal is 15.4%, and then the following year is up 21%. So, this is a bull market. If you can see here, as of last Friday, this would be 7.5% above the 35-week moving average. So the market is literally blasting off here. This is a bull market. Now, I want to bring us all back down to earth here for a minute because I want to talk about something that I think is very, very important. And I'm using the Value Line Geometric Index. Now remember, the Value Line Geometric Index is considered to be the index for the average stock. In other words, this index is not market cap weighted, it's equally weighted. Every stock, there's 1,700 stocks in the index, so it's a broad index, but it represents the average stock. Now, what I'm telling people right now, and I think this is really important to understand, you've got to have a bear market strategy. In other words, do you have a plan? Bear markets are going to be inevitable. Now, bull markets can run much longer than people realize. So if we go back here and look at the bull market that was back in 95 through 2000, I mean, we had a 5-year run here where this index went up about 1,000%. So you made 10 times your money from point A to point B. So the whole point of a bear market strategy is to keep you in the market unless there's a bear market. And you've got to have a strategy for this. And we do. We have a strategy. And what we tend to do, and we recommend that people do, is that you look at things like trend following. Here we can see where the trend is breaking down here at point B, where you're getting the 10-month moving average versus the 20-month moving average, and you're getting what you call a death cross. Now, the thing to realize about bear markets now, in 1929, if you had $1 million, by 1932, you're down to about $100,000. You lost 90% of your portfolio. In 1998, which was the dot-com meltdown, you lost 57% of your portfolio. And then the financial crisis, the average stock went down 67%. So you've got to have a bear market plan so that you stay in the bull market during the bull market cycle, which can go a long time. We just don't know. But you need to have a plan, because if you have a plan, you're going to sleep at night. Now, the other thing about bull markets is they tend to end in euphoria. In other words, where the shoe shine boy is giving you stock tips is basically what euphoria is. Now, are we there yet? I don't think so, because I'm not seeing inflows into my fund. I talked to a lot of other money managers out there. We're not seeing inflows, which means that people are still sitting on the sidelines. Now, I will mention that Bill Miller of the old Legg Mason, Bill Miller, who was a famous money manager, came out this week saying that he thinks that we're going to have a melt-up of about 30%. So he thinks the market's going up 30% this year. And the reason is that as interest rates move higher and people start losing money in their bond funds, now realize these bond funds have been going up basically for 35 years, that if you start to see deterioration in the bond funds, that all these people are going to start switching from bond funds to stock funds, and the stock funds are going to see inflows. That's something that I would really be watching, and I will be watching. So in a bear market, the thing to realize is that nothing works. Nothing works in a bear market. The only thing that makes sense in a bear market is to be heavy in cash. So again, trend following would be one part of a plan. You raise your cash levels. The other part of the plan would be watching I would be watching mutual fund inflows. If we start to see a dramatic increase in the amount of monies going into mutual funds, stock mutual funds, that would be a real warning to me. So just to bring you up to the current signal, we got a buy signal on this right around the beginning of right at the end of 16, beginning of 17, and we continue to see this particular indicator in an uptrend. Now, one thing I do want to talk about also is a particular stock, and it's Amazon. I saw an interview recently with a gentleman by the name of Howard Davowich. Now, Howard is one of the most recognized retail analysts in the country, if not in the world. His client list is anybody and everybody. And what he basically does is advise retail clients, retail companies on how to run their businesses. Now, what Davowich is saying in the interview is that it's all about Amazon. That this guy, Jeff Bezos, is the greatest entrepreneur we've ever produced. So when you start thinking about and investing in companies, you want to look for these special people. I'm talking Bill Gates, Sam Walton, Steve Jobs, the list could go on and on. But this guy, Bezos, is considered by Davowich to be a genius at the retailing industry, but we all know it's going to be more than that. It's going to be technology as well. And one thing that Davowich is saying is that when it comes to the brick and mortar retail, rents are down, lots of vacancies, online sales are affecting everything. So it's all about Amazon. Now, I went ahead and did another analysis of Amazon that I thought was interesting, where I'm comparing Walmart to Amazon stock price. Now, we go back to 2009. This is a weekly graph, and when the graph is going down, it means that Walmart is doing poorly and Amazon stock is going up. But I mean, you can clearly see that Amazon stock is dramatically outperforming Walmart. Now, Amazon is currently a $592 billion company. Walmart is $296 billion. A company like Target is $36 billion. So if Amazon were to buy Target, it's only going to be roughly 8% of Amazon's market cap. So this is the dominant player in one of the largest parts of the U.S. and world economy is Amazon. So there is a lot of rumors about Amazon making additional acquisitions this year. We'll have to see. Now, on the top five, we're seeing, again, the rotation is continuing. Here we have Freeport-McMoRan, which is copper. Smoke up a chimney. Basically, what we're seeing there is the commodity stocks are all starting to catch hold, especially oil. Now, here's an oil stock. This is HollyFrontier. Again, you can see the strong uptrend. Retail continues to be strong. Michael Kors is making the list. Here's a therapeutic company, a pharmaceutical company, Sage Therapeutics. Lots of breakthroughs in the medical field. It's just unbelievable. Again, the Chinese stocks are starting to improve. Here is YY, which is a Chinese software company. So all in all, what I'm saying is have a bear market plan. You'll sleep better at night. And if you have any questions on this bear market plan, because everyone needs to have one, give me a call. Thanks.